Welcome to another edition of Learning About Loans. Today I have with me Miss Tamara Pidwalny. Tamara and I have been working together since I think circa 2010. I just know it's about when one of my kids, our kids, were born. Tamara is one of the best freaking mortgage people I know. So grateful that we work together and we're on the same team. And today, Miss Tamara, what are we going to talk about? What is the Learning About Loans about today?
This is about the FHA Buyer's Choice DPA or Down Payment Assistance Program.
Nice. And I do know enough about, I don't know, honestly, this is going to be a good episode. And I promise you guys, I'm smarter than what I look here most of the times. But today, I think the part that I want to make or point out that this buyer's choice program, an FHA product with down payment assistance, is unique to us. It's not something that's widely known or widely available across, a whole bunch of lenders. So if you do learn about this today, that's awesome. If you go looking for it, I suspect you may not find it, but just throwing that out there that unlike normal programs that we do here, this one may be more of a niche product. So we're not trying to rub it in or make anybody feel bad, but the reality is this is more for us as opposed to just an industry standard for FHA. So, but Tamara, with that being said, I know what a DPA is. For those that don't, it stands for Down Payment Assistance.
Yep.
So I know what FHA is. I know what a DPA is. I have no idea what the buyer's choice is. So fill me in. Like what is, so FHA, for those that don't know, we'll put a link somewhere around here. Check it out. It's a government-backed program. It allows for lower credit scores. It allows for manual underwrites. It allows for a lot of just outside the box. It's not exclusive. This may be, but FHA in general is not exclusive to first-time home buyers. It gets dubbed that, but it's not necessarily first-time home buyers. So if you don't know about FHA, check it out. It is an awesome program. Most lenders do have that. The good ones do. I assure you of that. Check it out on our website for more information. But going now to the niche of what choice program, is that what it's called?
Yes.
The choice program. FHA Buyer's Choice. What is it, Tamara? Fill me in.
So this one is designed for borrowers who might have a credit score lower than a 680. There's a couple of options, and it does allow you to go as low as a 620. And there's no additional fees, where other down payment assistance programs that are industry standards do charge extra. This one does not.
That's huge. So let me restate what Tamara just said to make it extremely obvious. Down payment assistance programs. So I'll name a few, which are, here in Texas, and there's others elsewhere, but Seth, TDHCA, TSHAC, and I know it's a lot of acronyms, gang, but TSHAC, TDHCA, Seth, Chenoa, those DPA programs, the down payment assistance programs that exist, some exclusive to Texas, some, Chenoa, for example, is multiple states. They require money. They cost the home buyer money to do it. They're there to raise it. What I just heard from Tamara, the difference between this and the others is that this one does not charge any extra fees. Is that what I heard?
Yes. So TDHCA and TSHAC, both, if your credit score is below 640, they have their own 0.5% origination fee that they charge. So if you're getting 3% assistance and you have a lender that can charge up to 1%, and then the program is going to charge you 0.5%, then really you're only getting 1.5% assistance to you to help you with that down payment. So our buyer's choice does not have those extra fees. So you're getting the full 3.5% towards your down payment.
Dang. So just to say that again, and by the way, we'll put links for those other down payment programs that we just mentioned. If you want to check those out, they're great programs, not knocking it one bit. Those are fantastic. We use them a lot. But in this instance, what Tamara just said, if somebody has a $400,000 loan amount, if there's a 0.5 point fee to use a program, 0.5 point on 400 grand is $2,000, 2,000 real actual dollars of a fee that go towards these things. This does not have that. So Tamara, you mentioned the buyer's choice that we're talking about today goes down to 620 credit score. And it goes down, does it go to 680? Like, what if I have 700? Can I do it even though I got better credit? Or is it only, yes. Okay, cool. So 620 is the minimum. What's the 680? Like, is there just a price difference there or rate difference or anything? Nothing?
Nope. So really, there's two options. There's a forgivable option, and then there's a repayable option. So we'll get more in depth in those in just a minute, but the forgivable one says that you can have as low as a 620. The repayable one is going to require that you have a 660 credit score.
It sounds backwards. I'm not to call you out, but so you're telling me with a better credit score, I like I would think with the 620 they'd make you repay it. But you're saying at a 620 they can get the one that's forgiven. So you said it right. I'm just, it seems counterintuitive, but so sorry to interrupt you. But at 620 you can get the forgivable one, but at 660 you get the one that can be repaid, or at least you're eligible to take one or the other.
Yes.
Okay,
The biggest
sorry to interrupt
difference,
you.
the repayable one, the rates are lower.
Makes sense.
The forgivable one, the rates are going to be higher.
Makes
So that's
sense.
the
So if you don't have
biggest
to pay
difference.
back the money, they're going to hit you with a higher rate because of it. And that's why with the better credit score, they're going to allow you, air quotes, allow you to repay it so that you get a better rate. And to have the better credit score, they know you're a better credit risk and that you will repay it. That's why you get the reward of being able to repay. Because it sounds like, well, that's a punishment. I don't want to repay it. But you might in terms of the difference in rate. And if it, and we may be skipping ahead, ballpark me, what is that difference in rate between the 660? Is it a half point more in rate, a full point? Like kind of what's our, again, understand that things can change. I get that, but ballpark me on what you think the rate difference might be between repayable and not repayable. Is it half point, full point, to be determined
I
based
want
on
to
the
say, I
market?
believe it's almost a full point.
Okay, so it's worth it to repay it over the long haul if you can. It sounds like, at least from a number standpoint.
Yes.
Okay, cool. Keep going. I'm sorry I'm interrupting. I'm just, like I said, I'm learning with you.
No, that's okay. So if we break it down into the two, we're going to go with the 10-year repayable option first. So with the 10-year repayable option, there's two options for the assistance. You can either get 3.5%, and it's 3.5% based on your total loan amount. Most people think it's going to be 3.5% based on their purchase price, just like their down payment, but it doesn't quite work that way. So it's 3.5% based on your total loan amount. So you have your base loan, and then FHA has their upfront funding fee. So it gives you a slight boost. So it gives you a little bit more to borrow. And then they have a 5% assistance, which is also based off of your total loan amount. So that's going to help you cover your down payment and some additional closing costs. As well, to help keep the cash out of pocket to zero.
That's
And it can
amazing. Do
also
the
be
other
combined
programs,
with,
sorry to interrupt you, sorry, but that's amazing. So do the other programs, TShack, Seth, TDHCA, all that stuff, do they do it off the sales price or do they do it off the total FHA loan amount?
they all do it off the total FHA
Okay.
loan amount.
So for those, to restate what Tamara said, guys, FHA's loan amounts, there is a upfront MIP that gets automatically added on. So that's why she keeps clarifying to say it's off the bigger loan amount. So in other words, you get more money. So it's a good thing, what she's saying. So sorry to interrupt. So there's two options for the 10-year repayment, 3.5% off the total loan amount or 5%. That's where I interrupted. Sorry, keep going.
Right. And so the 3.5% is basically, it's truly going to cover, let's say you're buying a house that's $500,000. So ballpark with that 3.5% assistance, it's like maybe less than $1,000 of your own down payment that you're going to have to cover.
Wow.
Where with the 5% assistance, it's not only going to cover your down payment, but it's also going to cover, I think, about an extra $3,000 of your closing costs.
Wow. That's amazing. Truly amazing. So we do this down payment in-house, our thing, to where it's like we don't have to use those others. So they save their money on the closing costs in terms of fees for what, because we don't charge for it. And then the rate, again, to be determined on what, how much they want to borrow. I assume if you go get 5%, you're going to pay a slightly higher rate than if you get 3. Is that true? Or 3.5?
Yeah.
Okay.
The rates are the same. But you are going to pay where we were talking about those points before, or those costs. You're going to pay some kind of cost like that with the 5%, just because of where the market's at right now. But in a normal world, there would be about maybe a 0.5% difference between the 3.5% and the 5% for the rate.
So let me elaborate on that real quick, folks, because it's not, but it sounds like she may have just contradicted herself. So this program, again, we do not charge a fee for this program. However, what she just said sounds like there might be a fee if you do 5%. Here's why. Interest rates, if somebody calls and says the rate's X, so you get this X rate. Well, if somebody wants to get a lower rate, they can pay points. And again, we'll put a link somewhere down around here for points so you can understand that more, but you can pay more to get a lower rate. The way the market is right now, and conversely, by the way, you can go up in rate a lot of times and pay and get lender credit. That's kind of how fundamentally they work. But what Tamara's saying is the way the market is right now, at the time of this taping, and it's kind of been this way since COVID happened, after COVID, the market's not as sexy and as easy and different as it used to be. So the rates are going to be the same, but because you're getting the same rate for the 5% that you are for the 3%, the rate has the associated fee, not the fee for the program. It's because you're getting the same rate for the 5% assistance that you would be for the 3.5%. There is a fee associated because that rate staying the same. And you're gonna have to trust me on this one. Again, if you really want to know, go check out and see how points work. Call us. We'll be happy to walk you through it. So that's not the point of this video, obviously, but understand that's not a fee for the program itself. It's the fee for choosing the 5% and just the way the interest rate market's working. Later on, the market becomes more normal, like it used to be. The rate for the 5% would be higher. That's just not an option right now, is what she's saying. So sorry for that little bunny trail. Coming back to you, Tamara. So the 10-year repayment, the 5% or the 3.5%, and I assume that 10-year repayment starts like right away on day one. Is that part of your mortgage payment, or is this something you pay different, or how's that repayment work?
So it is considered a true second lien. So it comes with its own interest rate. And it is repaid at closing. And there are 3 options. There's a 10-year due in 10 years. There's a 10-year due in 20, which means on month, what is that? 121.
240, right? So 20 years from now?
10 years though.
Oh, so yeah, month 120 months in the 10-year, correct.
So
you're
on
saying
month,
a month,
on month
121.
121, you're going to have a balloon payment.
Yeah. So in other words, guys, if you select the option that says, okay, I'll repay this thing in 10 years and I'll do a 10-year amortization, then it's just normal payments, like a second mortgage payment, right? So that's what you're telling me. It's a second lien. So it's like a second mortgage. So you make your normal, air quotes, normal mortgage payment for the first, and then you'll have this really small baby one for the down payment assistance for the second. If it's 10 years, due in 10 years, it's just going to be a normal, air quotes, normal mortgage that gets paid off in 10 years. If it's a balloon payment or a due, what they call 10 due in 20, you're going to have it a smaller payment, like it's a 20-year amortization, but they are going to say at the end of 10 years, so a month after 120 months, they're going to say, you owe us the rest of this money today. So 10 years from now, you got to make sure you have a plan to pay off the rest of that unpaid balance that you then owe. So check out, we'll put balloon financing somewhere down here too, so you guys can check that out and have it. So those are the 2 options. What happens if it's forgiven? Like
3 options, 10,
oh,
10
I'm
due
sorry.
in 10, 10 due in 20, and 10 due in 30.
Same. So the third option, sorry, I cut Tamara off earlier. So the third option, same as the first, that's the 30 has the lowest payment because we're going to amortize it over 30 years. But it just means that balance at the end of 10 is going to be bigger if you haven't proactively gone through and paid this aggressively over the 10 years that comes up.
Right.
Got
And
it.
if when rates drop, let's say 5 years down the line from now, rates have dropped, and you have the 10-year due in 10, you can refinance both loans into one brand new FHA loan. And it's going to be that smaller balance because you're making larger payments towards the amount that you borrowed, but it would be the same across the board for any of them.
Are there any
where you
prepayment
aren't
penalties? Are there any
permitted-
prepayment penalties for these? So if I
Yeah.
refinance and put them together, no fee, no harm, no foul. So even if rates drop a year from now, somebody could refinance and do it and put these together. Cool.
Right.
Love it. Love it. Love it.
So that's the repayable portion of it. The forgivable portion, we used to have a 3.5% and a 5%. Right now, the 5% is suspended. So we're just going to talk about the 3.5%. So like I said, the 3.5% is about 1 point higher in base rate. It's forgivable after 5 years. So on month 61, if you wanted to refinance or anything, the amount of money that they lent you up front is completely forgiven. You wash your hands of it, you walk away, you owe nobody anything.
So do you have to make payments for those first 5 years?
No
So
payments.
there's a balance sitting out there. Let's just call it 15 grand. Let's say whatever purchase price that equates to, whenever you needed this 3.5%, they gave you 15 grand of this down payment. They give you 15 grand of this. So you got that $15,000 second lien sitting there. But in this case, no payments are required because it's going to be forgivable. You live in the house for at least 5 years. After 5 years, all done. Right?
Yep.
No, like the 15 grand just goes vanishes and you're good.
And it's not accruing any interest.
No interest. So it's just 15 grand. Here you go. Love Tamara, love Mark. Here's your 15 grand. What happens in year 2? Rates drop and they want to refinance and put this together. What happens?
Then you have to put them together and refinance them back into one loan.
So it just means that guys later on, when you go to refinance later on, if it's within that 5-year period, kind of no harm, no foul. They're just taking that 15 grand that's owed and they're now going to put it with a new mortgage, right? You're going to combine that. And then you do start paying on it because now you've kind of, in effect, gotten rid of that 15 grand grant or down payment assistance. And you've now made it part of your quote normal loan. So you can refinance, no prepayment penalty. It just means that you're going to have to, pay that off and include it. And I suspect, Tamara, and you may not know this, can they refinance their first and resubordinate that second? I'm going to guess no.
No.
Okay, I didn't think so. So you can't, just to say it in English or in layman's terms, you can't just refinance your first if rates drop and then leave the second alone. They're going to make you, if you refinance, they're going to make you put them together. Correct. If it's within that first 5 years.
That is correct.
Got it. Okay, cool.
In the state of Texas, this is something that is different and compared to T-Shack and Seth though. Mm-hmm. Sometimes that 5% assistance is might mess with your debt ratios. And so Texas being very strict about certain things, we have to make sure that it doesn't exceed a certain amount of your actual purchase price. It cannot.
So just making 100%. Sure you're not getting too much. Like, so without going into becoming an underwriter, just know that in Texas, it's going to be a little harder than maybe if you're outside of Texas. Can we do these in all states? Cool.
Yes.
Cool.
All states. The program is available in all states.
And you brought up a really good point. So are there income limits? Like if I make too much money, because other programs like Seth, T-Shack, et cetera, they have income limits. Like if you make too much money, you don't qualify for those programs. Yes. So you just shook your head. Like we don't have any income limits.
That's not only we're just giving you. I had a borrower who they make a lot of money between the two of them, but they didn't have the funds for the down payment. And that's how I found this program.
That's amazing.
No income limits, no purchase limits.
Dadgum, girl. You've done good.
What else? Stay within the FHA loan limits.
What else? So FHA loan limits. And for those that don't know, FHA, the loan limits do vary by county. A lot of the counties, especially in Texas, can be the same, but there are some differences. So please be sure to check with us or anybody that you may be getting a mortgage through to make sure that you're within your county limits. And they've gotten much higher. What else, Tamara? What am I forgetting? Any other questions or any other highlights? It sounds like we've kind of hit most everything: cost, rates, payments. What else am I missing?
Most bond or down payment assistance programs do allow for that mortgage certificate credit that I know we're going to talk about on another time.
It's MCC. Look around. There's a credit, and basically, in 10 seconds or less, what does that MCC do for you?
It's a mortgage credit certificate for when you file your taxes, but in the mortgage world, it also allows us to give you a little bump in your income to help for qualifying.
Wow. I'm telling you guys, this gal is good.
But that's not allowed with this program.
The MCC is not allowed with this program.
No. Like other programs, you can combine them. This one you can't.
We've given them so many good things here on this one, but that's where we draw the line. Is no MCCs. Okay, got it.
And last one is you're not required to be a first-time home buyer for this program either.
Wow. So just to be clear, guys, the mortgage world, I use air quotes, the mortgage world real, forget the air quotes. The mortgage world considers a quote first-time home buyer to be anybody that has not owned a home in the last 3 years. So you may have owned a home 10 years ago, sold it 5 years ago, and you've been renting for the last five. You, by definition, are a first-time home buyer. But what Tamara is saying, unlike a lot of those other programs, this is for anybody. You can own a home today, be buying a new home, and still qualify. Whereas the other programs, a lot of the other programs, we're going to say it's only or restricted to a first-time home buyer. So in this instance, it's very all welcoming, no cost. Like this thing's a freaking no-brainer. And I mean that this is awesome. Tamara, what else? What else? I keep thinking you're done. You keep giving me good things. What else is out there?
I mean, that's really it. They have a minimum loan to value is 90%. So you can't want to put 20% down and get this program. It has
It would
to
make
be
sense. It's a
with-
down payment assistance. So if they're not going to let you just put down 20% and then get free money. So you're
Right.
saying
You
the
can put down
max,
10% and
yeah,
get
the max they
5.
can put down is 10,
Right.
right? Okay. So if they do have some money of their own and they need to put down more, and you would think, well, why would somebody do that? Maybe they need to qualify by putting more money down. I'm assuming, is that why they would do that? Like they're not quite there and they need to put some of their own money in it in addition to getting this down payment assistance to get to qualify to get the payments down just a little less. Am I right with
Where
that?
their purchase price is just slightly above the FHA
Good
loan
one.
limits.
Smart, right? So those loan limits we talked about, guys, if you're just buying a little house, or a little bit too much house, if you can put down some money to get in the FHA loan limits, that's probably the more likely scenario
Right.
from what we just described.
That's
Tamara?
pretty much the gist of it. It's super easy. It's I was amazed when I found it because I was able to help these longtime clients of mine. I've helped them with 2 other loans before. They're planning to grow their family and want to move closer to her work, but don't have the money for that down payment right now. So I was able to find it. And now I think of so many other people that I wish I had had this for prior.
Yeah, and again, this is relatively new. So don't think we're just learning. We didn't do our jobs before. It's just a new product that has come out, and we are grateful we have it. And I'm going to go on the limb and say at this moment, this is the greatest down payment assistance in recent times that I know about based on everything. Would you agree, Tamara, based on the things you do know? It's a bold statement. How about just say it's really good? How about that? We'll say it's really good.
I would say with the amount of restrictions that are not on this program.
Yep.
If you are not rate sensitive, this is by far probably the best ones out there.
Yeah, again, guys, you're going to pay a little higher rate on that second for obvious reasons, and then the mortgage in general. But for quote free money, at least upfront money, like it's almost a loan for your down payment, it's really attractive. So, if you do have questions, again, check out the Mortgage Mark team. Tamara's incredible. We've been together for, like I said, since 2010, so a very long time. We appreciate you listening, learning about loans. Check us out, Tamara. You blow my mind every time we talk, and I'm just so happy that you're so good at your job. So thanks for joining us, and we'll see you next time.